So I'll talk about what's happening right now from what I see. What's propelling the gold market. This will be focused on gold and silver. What the majors are doing. And then we'll trickle down to what's happening for the juniors. So, I mean, this is the big deal, is the U.S. debt service costs. And the debt has got up to $36 trillion. But the big thing you want to look at is the cost of servicing the debt. It's now exceeded the budget for national defense. And if you look at it, I mean, this was from this Neil Ferguson economist at the Denver Gold Show, which is now called the Mining Forum Americas, is that there's an issue when countries start exceeding the cost of servicing their debt over the cost of their defense budget. And that's almost like a signal of a decline of empire. So there's a very important underlying thematic for the US government, or the monetary policy, is not just to have full employment and keep inflation to a level of 2 to 2.5%, but also make sure these costs don't spiral, because there doesn't seem to be an issue with them actually taking on more debt. That doesn't seem to be an issue. And so the other question is the central bank purchases. So the other thing is the diversification away from the US dollar, for all the reasons of US hegemony, as well as central banks diversifying away from the US dollar. And it's not only the central banks, you can see the speculators as well putting in shorts on the US dollar. All of this ends up being very bullish for gold. Short term, but also this is more long term. It seems to be an underlying thematic right now. If the gold price ever does fall back, these guys, the central banks, are definitely buying. And so the other thing is the gold ETF demand. So the gold ETF demand for the first half of 2025 was up about 14%. And importantly, the majority of that in terms of volume is North America, but the biggest increase was actually Asia. And importantly, for companies that produce gold and are in equities, North American demand for gold ETFs bleeds into equities. So that's a positive. If it's just central banks buying gold, that won't generate the kind of record highs that we're seeing in individual companies. And they'll still probably generate the same amount of cash flow in that, but potentially nobody's going to take notice. I mean, Agnico just put out this thing that they're right on Times Square now. They put out an advertisement on Times Square, so it is reaching a bigger audience. And so this was taken from the end of last week. These are the commodities asset classes I follow. And you could tell the GDXJ on this side was the best performing asset class, almost double that of the uranium. But you could see gold and silver both outperformed the S&P and the NASDAQ over that same period of time. So that's what people are seeing. So not only is the gold price going up, but importantly, the equities are providing leverage, which they hadn't always been providing. Interestingly, when I was at the bar at Beaver Creek, they had this in the background. I don't know if anybody was watching that, but this was on for almost a half an hour before they switched to a football game. But anyway, the big thing about the Precious Metal Summit, it's an annual event, and it's not always about gold. When lithium's up, you see a lot of lithium companies. When other commodities are doing well, they invite those sort of people. But this was really precious metals for precious metals. A lot of people smiling, a lot of people happy. Investment bankers that I hadn't seen in a long time were there. And one way of measuring a bull market is actually weighing an investment banker. So if they weigh a lot, it's a good sign. If they're skinny, and going on marathons, it's not a good sign. So, and what you're seeing was a lot of meetings, brokerage firms were sponsoring the event. They had a lot of bankers there, and these deals were getting pitched as they were doing meetings. And hence what you're seeing now is a lot of that flow into bought deals and private placements that are happening now almost every day. And the brokerage firms are hiring analysts, not firing them. And I got invited to a site visit from somebody I hadn't heard from for about 5 or 6 years, inviting me to see a company that I'd seen maybe 15 years ago on a marginal asset, but now they have a private chartered plane that's leaving Avon, Colorado to go straight there. Steak and red wine, a lot of consumption, noticeably higher than last year, but also the steak restaurant that I went to on Thursday ran out of steak by Thursday. So everybody was having fun. And so in terms of numbers, the Precious Metals Summit, the list of companies, the publicly listed companies that actually attended, was up about 40% year on year to 220 companies publicly listed that were presenting. What you would notice at the Precious Metals Summit is a lot of people attend outside. They're delegates, but they're not on the meeting schedule. And a lot of those companies were doing similar meetings, but not like in terms of the formal meetings that the actual conference organizes. So the number of attendees up about 17%, 1,750 people attending, and the number of meetings, 9,200 of those one-on-one meetings. And it's not only corporates anymore that are doing these meetings. There's a lot of banks, brokerage firms, private investors taking these meetings. At the Mining Forums America, which is more about bigger companies, higher liquidity, mostly producing, the Newmonts, the Barricks, the Agnicos, they were up 33%. 4,000 formal meetings, 13% more delegates. So obviously those delegates that are going there are taking more meetings than normal. And so we'll start top down. So let's talk about what the majors are seeing. So peer group of 28 companies that I presented for our subscribers about a month ago, but you can see the average return in the first half of the year was about 34%. But in the second half, it was 67% when gold went up, when it spiked. So there was only a few companies, of only one, that had a negative return in the second half of the year. Everybody else was positive. And if you look at what's driving that, is that it's not just, oh, the gold price is going up, they're doing well, but it is a bit of that, because most of the companies, the big companies I saw, their costs actually went up, but they went up maybe 8 to 10%, but the gold price went up almost 30%. So their margins on a weighted average basis, if I took all the revenue from those 28 companies, I took their margin divided by the total revenue, it would be 52% because of those companies on the right-hand side. If you just took the weighted average of, unweighted average of all the companies, it'd be about like 48%. But importantly, that margin is translating into free cash flow. So what you see here is this total bar would be revenue. And so the green bar would be how much of that revenue is actually free cash flow. And free cash flow is the money you can use to pay out dividends, buy back shares, do new capital projects, or that sort of thing. So that's the money you want. That's what shareholders should be concerned about. And so the weighted average, taking all the free cash flow from those 28 companies, dividing it by revenue, was about 34%. So that's very good. And so the left hand shows you the balance sheet. So the blue is their working capital. The red is their long-term debt. The line is their net debt. What you want to see is these guys down here. They're doing very well. The guys up here have more net debt. But on average, most of them are doing very well. There's a lot of companies out there with no debt. And then what they're doing with this free cash flow, is some of these companies, especially the mega majors, are not talking about growing anymore because it's hard to grow. So you take this, which is all of their free cash flow. This is for every company is like that. But you take this, that would be Newmont. So that's all of their H1 2025 free cash flow. This is how much went to dividends. That's how much went to share buybacks. So if you take the total of that, and that's 64% of that free cash flow. So 64% of their free cash flow is going right back to shareholders. And that's what shareholders like to see. And hence Newmont's done very well. But you could see some company like Lundin, which is a high margin asset, single asset producer in Ecuador, they're mostly about dividends. And so they're putting out almost 70% of their free cash flow back to dividends. So people aren't thinking about them with respect to geopolitical risk. They're more thinking about them with respect to 70% of that free cash flow is coming back to me. So these are a lot of the big companies. Fresnillo, this is their OTC ticker, but they were one of the best performers in the first half. Silver, Mexico, but still almost 50% of that they're giving back. Mostly what they do is dividends. But there's a blend here between share buybacks and dividends that people are doing. And so out of all that, what are the trends of the majors? So Barrick, who's also done very well, they're divesting assets. We saw that with Newmont, and I'll get into that a bit. But this one project, Alturas, that they've had on their books for a long time, decent-sized gold project, 5 million ounces in Chile, but they basically sold that for less than $10 an ounce recently, not 5 years ago. And then they recently sold to a private company, which will become Hemlo Mining Company, the Hemlo Mine for about $1 billion. But still, that was about $270 of total mineral inventory, which is measured, indicated, and inferred. So what Barrick is doing is they're pivoting, as they've said before, into those assets that make the most sense for them, which is the Carlin Trend, Cortez, and now 4 Mile, which I'll talk about, Turquoise Ridge, Lumwana, which is all copper, and Reko Diq. So if you look at Barrick's growth, you could see a lot of that's copper production going forward. And the big one here is Reko Diq, but it's also Lumwana. So if you look at 4 Mile, and a lot of people don't realize what's happening here, but 4 Mile is an amazing deposit, discovery. So this has got about, this has got about 17 million tons, 18 million tons. This has got 77, that's Gold Rush. This has got about a half the grade. This is mined. This is what the exploration upside on this one, 32 to 34 million tons of almost a half an ounce. And importantly, this is not on Nevada Gold Mines property. This is not part of the joint venture. This is 100% Barrick. So you know why they're super keen on this. But look at the Gold Rush produces now 380 to 400. They're thinking that this could put out 600 to 750,000 ounces over 25 years. This deposit was valued by one of the banks that covers BMO, it was BMO, that covers them at about $18 billion. So the last I looked at Barrick's market cap, this would be about a third of their total value is this project. This does not take a lot to build. I mean, the Reko Diq thing will take at least $7 billion probably in the end. This is like less than $2 billion, and it's in Nevada. Hemlo is what they sold. So they're selling assets that right now is not going to move the needle for them. But in this environment, juniors can raise capital to buy these assets. And we'll see a lot more of that. Newmont's basically got rid of most of them, but I'll show you which one of them that they didn't. But you can see like most of it's mine, but these guys are going to go back in and do it differently. Maybe they'll change the cutoff grade. I don't know. But obviously Orion Mine Finance, they're keen, and Wheaton are keen. and helping them purchase this billion-dollar asset and take it off of Barrick's books. So that's something of what Barrick's doing. Focus on a few projects going forward, divest, and not always get the value you think you're going to get. Like not hold out all tourists forever and still get $20 an ounce or whatever, or less. They'll just sell it and get it off the books. And so this was the divestiture plan. I think I've shown this before last year in terms of date down here, assets sold, cumulative sales of about $4.5 billion. They sold most of it at the end of 2024. The one that was straggling that had no bid was Coffee, which is the open pit heap leach project in the Yukon, not far from Casino. So open pit, oxide. It was originally acquired by Goldcorp for $520 million or $400 million US. It sold for 150 in a market, in a gold price environment that's obviously much higher. But interestingly, I mean, the junior that took it, Fuerte Minerals, they only paid $10 million upfront in cash of that 150. Most of the value is actually ascribed to the 3% NSR royalty that Newmont's going to keep. But if you do rough numbers, assuming a gold price of $3,000, mine plan assumptions of the 2016 feasibility study, undiscounted, the 3% NSR, my calculations, get you to about 170 million-ish. You know, so if you discount that, you know, you probably could get down to the 100 million number. And so in terms of valuations, this is enterprise value per ounce of sale of total mineral inventory, which is the light blue, and then reserves, because a lot of these projects or companies don't have reserves. Some of them don't have the dark blue, but you can see like what's gotten bought and got a high price for, like the silver projects like Silvercrest and Gato. Those were bought a year ago or more, and those have done very well for Coeur and also First Majestic. Centamin getting purchased by AngloGold, Adriatic recent purchase, polymetallic in Bosnia, Mag Silver recent Pan American, and so Hemlo's right there. Hemlo is better than some of these other projects, but most of everything left of them is development. Because most of what Equinox bought Calibre for was actually Valentine, which is just going into commercial production. But everything else, Reunion, Prime, and Coffee, which would be the most to the left, are all development assets. And so if we look at Newmont has done well. They've been generating free cash flow, and as I showed, they've been putting that back to shareholders. There's even in this gold price, now they're worried about their own costs because on an annualized basis, they're spending almost $1 billion on G&A, exploration, and financing. So the thing that they can cut, and they're going to look at cutting, is their G&A right now. So that's their big goal going forward, is to generate more free cash flow by cost cutting. It's not about more M&A. So their goal is basically to drop their all-in sustaining costs by about $300 an ounce. So they were close to Agnico until about 2020, and then they started post-COVID diverging significantly. And so this is the graphic that they want this to get back down to this. So in terms for juniors, multiple sources of capital. So these are the numbers for financing juniors and intermediates from 2023 to August 2025. And if we take the year-to-date numbers to the end of July, it's about 70% up year on year. So about $9 billion is represented by that. So the total financings, again, are led by these, which is the gold. So half of that $9 billion, more than half of that, is just gold companies financing, which is up 114% year on year. And that's just going to go up higher because, as you guys have seen and I've seen, there's a lot more financings happening and have happened since the end of July and post Beaver Creek in Colorado. And so that generates more news flow for us that follow these companies. And so this is from the S&P Global Market Index. And so these are drilling, number of drill holes. So year to date to August, the juniors reported 24,621 drill holes, up 45% year on year across about 1,200 different gold projects. And so by the end of the summer, I was hearing, like before, maybe, I don't know, 3 or 4 months ago, the assay turnaround time was about 3 to 4 weeks without a priority. It's gone to 6 to 8 weeks. But now I'm hearing from some companies that are doing multi-element assays as well, it's getting to 3 months. So all that news flow is now getting into all the providers. People will have harder time finding rigs, and assay time turnarounds are going to be longer. And so some people will start putting out more visuals, knowing that the assays will take a long time. And so if you took those same 28 companies, the big companies, and looked at how much they actually spend on exploration in the first half, all of those companies spent about 2% of their revenue on average on exploration. The 6 majors spent 70% of the total. So most of these companies are not spending a lot. So I think the opportunity for the development plays and a lot of the exploration companies are these guys that can still show growth and that have the cash flow, they have the better balance sheet and that, but they're going to be doing more strategic placements, equity placements, and also joint ventures going forward. That's the easiest way for them to do it because they're not spending a heck of a lot on exploration. So one of the companies that is presenting here is Liberty Gold, and Liberty Gold, they just announced a $28 million strategic private placement by Centerra. The tables here are just showing you Black Pine was one of their projects, Gold Strike, which is one of their projects, versus the 2 heap leach projects that Centerra hold. The one in Turkey, Öksüt, is operating. Goldfields they bought, and that's in Nevada. But all this is telling you is that these companies are taking strategic stakes, less than 10%. It's a nice endorsement for the company that's going into a feasibility study on a similar sort of open pit heap leach oxide in the States, southern Idaho, no trees, no waters of the United States either. So, and water access and power access. So these are the sort of projects I think that people in the intermediates will see, well, hey, this is a project maybe I can build. So when you're doing due diligence, the strategic private placements might not go to every company, but you got to really look at the assets. The assets on the strategic private placements will matter more sometimes than the people, but the people tend to have those assets that work and have the connections. So it'll always come down to people. And so their big thing was also the potential to get more ounces. And so these guys have been drilling this leach pad, and they're finding, I'm not sure if this leach pad is going to give them that many ounces, but the point is that if it could just carry the cost of removing it, there's more ounces here that they'll be able to access. And that's another upside for Centerra. And so another thing that we should, like, I'm not talking about base metals or critical minerals here. That's a whole different source of capital from the government and from Silicon Valley that I've talked to subscribers about, but that's not where they're going. What they're going for is, what's driving a lot of the new money is actually cryptocurrencies. Tether Capital. So these guys are not the cryptos that see Bitcoin versus gold. They see Tether stable coins plus gold. So Tether has been, not only do they stable coins on a whole bunch of foreign currencies and currencies exchanges, they also do a Tether on gold. And now they're branching out into buying into what most companies, either in Silicon Valley or these cryptos like are royalty companies. They love the idea of royalty companies, small G&A, all revenue, less technical. So this EMX Elemental one is one to watch. That's happening now, closing now, but you can see Tether took out La Mancha, diluted Alpha Stream, which were big shareholders of Elemental. Now they'll own 27% of the new company. So this company going forward will not have a lot of financial constraints anymore in terms of what they can buy. So we'll see a little bit of this coming into the market as well. And what they're doing is cleaning up the balance sheet. So at the same time they're combining the companies, they're going to raise the money about about $100 million injection on a private placement, and that's going to clear out all the debt that EMX had as well. And so you could see the performance in the share price for 2025. EMX in dark blue, and then in green Elemental, and this was the GDXJ. So the GDXJ was outperforming these companies until about July. Then we had the Tether placement. It wasn't me making EMX a top pick that did that. It was the underlying bid that was coming, because these guys had been talking for 18 months to 2 years. The two things that triggered this was Tether coming in and them waiting for Zijin to announce a discovery at Timok, which was the MG deposit. So all of that combined, got the bid on EMX and drove its share price higher. Headwater, which is here, they've done a lot of this, but they do a hybrid model in that not only do they do joint ventures, like they just announced today that Newmont is going to stage 2 of their earn-in agreement on Spring Peak. So that's a project that's getting totally funded by a major. So that's not money they need to raise. But they also will raise money to drill their own projects. Another deal that they did do, which was a month ago or so, was with Oceana. And that's bringing in a company that also does a similar style of deposit in other places, these low sulfidation epithermals, looking for low tonnage, high grade. And they also did a private placement with the same group, Centerra and Intermediate, last year for about 10% of the company. So you'll see a lot of these hybrid models attracting different sorts of capital, but not only the capital at project scale, but also at equity. AMark, who's here, that company's been around for a while because, as most of us know, exploration takes a long time. And especially for copper, you need deep pockets. And having a partner like Freeport and Boliden and Duke and Freeport Enjoy, it's, people will think about this as an overnight story, maybe wrongly, but this takes a long time to happen. So that discovery that they had Aurora, that's what is driving their share price to record levels. And now Freeport has just agreed to go to the next stage and earn in another 10% by spending $75 million over the next 5 years. So that's another thing you should watch. There's nothing wrong with having 20 to 30% of an asset that Freeport wants. Okay, so lastly, I might just do this. Okay, low interest rates, spiraling U.S. debt, central bank diversification, especially the BRICS, underpinning negative U.S. dollar sentiment, supporting gold and silver. Signs of a bull market were all over the place with precious metals. Some signs are here as well. Majors and intermediates are providing the leverage that shareholders want and new investors want. Now we're getting that 2 times. The majors knowing that they can't grow anymore because they have to replete almost 8 to 9 million ounces a year, are focusing on giving back to shareholders and cost cutting. So there's even more money to give to shareholders. Juniors are obviously finding it a lot easier to raise money, but now there's a few more sources. It's not only retail, it's strategics, intermediates, and it might even be people from outside like cryptos. All of this is generating more news flow, which is getting into the service providers and potentially clogging that up, which is, one of the issues we'll have. Good problem to have, I guess. Valuations are up, obviously. So here's the big issue of surviving the bull market, is knowing what to buy, because everything's going up. It is a question of turkeys do fly. So now separating the wheat from the chaff is a little bit easier, because before you were thinking like only the good ones can raise capital. Everybody can raise capital. So for alpha returns, which is what you want from an explorer, you keep all the same parallels. Focus on management, asset quality, what you need from a jurisdiction, share structure, whether that project's permittable, especially if it's in development stage. Are there any underlying issues with social license to operate? And basically those ones will survive this bull market. All right, thank you very much.